means for business value. And secondly, we look at what is a business worth. Now that takes a look at the current business valuation methodologies in use today by business brokers, accountants and professional advisors. Chapter 3, Who might buy it? Looking at the types of buyers, it is never too early to start thinking about who might buy your business. Whilst you may not know for sure who is going to buy your business, you will gain great advantage from considering what features would appeal to what sort of buyer. The different types of buyers we will consider here are investor, individual buyer, and corporate buyer. The investor. This type of buyer wants a business that is almost bulletproof. They will pay top price, however everything must be in place so that they don't need to get involved in running the business. Look at this like an investment in property where a tenant is in place, has been for a long period of time, and the future looks assured for the person investing in that property. A business for such a buyer must tick almost all the boxes that need to be ticked in the areas that we consider below. The individual buyer. An individual buyer is usually someone who doesn't have another business, or at least if he does, he doesn't intend to roll the business in together with that one. This is a buyer often referred to as mum and pop buyer. A great percentage of these are first-time buyers. This buyer really appreciates systems in the business. They will often react more to emotion in the buying process than another buyer. This type of buyer will heavily rely on their financial advisors. However, they don't necessarily come to a decision on business price with a lot of sophistication. Often they are buying a job, and quite often building wealth is not high on their agenda. The corporate buyer. This buyer already owns a business, and the plan is to incorporate this business with the other business that he or she has. This buyer is generally more sophisticated since he or she has gone through the process of certainly running a business and possibly buying a business before. When a company buys another business, there are potential savings to the buyer on costs that won't have to be incurred in relation to the new business. For example, the new business could be moved into the premises of the buyer, saving on rental. Certain wage expenses could be saved as jobs are merged and staff let go. Accounting costs, bookkeeping costs, administration costs, and a whole host of other costs could be absorbed. A well-prepared vendor can look to capitalise on these savings and boost the price accordingly. The buyer, however, may say that the savings are their good fortune and should not boost price by virtue of the addition to profit caused by these savings. It's all up to the negotiations between the parties as to who gets this extra value or advantage, but it is good to start thinking about this now. Chapter 4, What is a business worth? And why do you want to know? There are many reasons why you want to know how to value a business. The first is that you should be building towards a target business value, and if you understand the business value procedure, you will know at each step of the way how far short you are of your target. In other words, in terms of value, where are you now, where do you want to get to, and how are you going to get there? This program looks at how you're going to get there. The second reason is that you need to understand whether, when you are building your business, you are also building its value. Only a good understanding of business valuation methods and concepts will ensure that you are building business value at the same time. So business valuation general principles. What is a business worth? The stock standard answer to that question is whatever someone is prepared to pay, and that's accurate. An accurate description of what business valuation is all about. This is what we'll see later is called its market value. A thing has no value unless there is a buyer for it. There is a market when there is a buyer and seller for an item, and there is an efficient market when there are enough buyers and sellers to enable a transaction at fair value, and where there is thorough information about the asset, enabling an investor to make the right decision about whether to invest or not. A classic example of such market forces at play today is in the online arena with sites like eBay and Groupon. These are examples of efficient markets. That is, the market is big enough and there are enough buyers for sellers to be able to receive a fair price for their products. Real estate is a similar market. Values can easily be assessed according to recent sales, and many houses share similar features. Example, location, number of bedrooms, aspect, type of building, age of building, and so on. With business sales, it is not so easy. With the possible exception of franchises in certain industries and areas, no two businesses are the same. Hence, we have a number of ways of valuing businesses. I will discuss a few of them here, but start thinking now about the amount for which you want to sell your business. Write that amount down. Let's look now at the different ways of valuing a business. There's a multiple of profits method, asset valuation, discounted cash flow, and market value. The multiple of profits method. This is the most common method used to value a small business in the markets that we're talking about. One simply finds the profit of the business and multiplies it by what is called a multiplier. Let's say that the profit of a business is $100,000 per annum and the multiple we choose is 2. That would give us a business valuation of $200,000. Now that is a pretty simple explanation, but it illustrates the point. Another way of talking about it is to talk of a payback period. A multiple of 2 also means a 2-year payback period. It would mean that the buyer would look to get their money back in 2 years. Again, we speak about this as a return on investment of 50% per annum. A payback period of 3 years would mean a return on investment of 33% per annum. Now, whether it be 50% or 33%, such a return on investment would suggest the business is risky. Compare it with real estate or the share market, where a return on investment of 10 to 15% is talked about because of its lower risk. Put the money in the bank and you'll struggle to get 5 or 6%. It's probably seen as about the safest of all investments. The lower the return on investment, the lower the risk. You expect to be able to get your money out of the bank when you want it. The higher the risk, the higher return on investment that is demanded by the investor. You will also hear accountants and brokers talk about this method in terms of the future maintainable earnings method or return on investment method. So what is profit? The answer is that profit is a different thing to different people. For example, at this very small business level, or what is called micro business level, profit is what the owner gets from the business, including their wage. It's often called return to owner. At this level of business, the value of a business is a multiple of this figure. With larger businesses, profit is defined as the surplus after all expenses are taken into account, including all wages and the owner's wage as well. For the purpose of our discussion, the multiplier that we use for micro businesses would be between 1.5 and 3 of that owner's return, and for larger businesses between 2 and 4 of that return to owner after wages, often called EBIT, earnings before interest and tax, or EBITDA, earnings before interest, tax, depreciation and amortization has been taken into account. So it's very important to understand whether we're talking about a multiple of owner's return or a multiple of EBIT. In fact, we could stop and talk about this topic for days and still end up more confused at the end than we were when we started. However, I simply want to give you an overview, a helicopter view of business valuation, Look for more advanced treatment by searching on the internet or consulting the more detailed manual of mine that I spoke about earlier. I love this method because it points out how you can obviously boost business value by boosting sales, but also by improving the way your business is structured, boosting the multiplier accordingly. And a good part of this program is devoted to showing you how you can boost your multiplier by the way you grow your business. The asset valuation method. This method is used usually when there is no profit, not even a wage for the owner. There may be a wage for the owner, but the asset valuation method you'll want to use if it shows up a value that's higher than the value you'd arrive at by doing some sort of profit calculation on the small profit that the business has. This method you'll find is used when all that there is left of value in a business is the assets, both tangible and intangible. I hope when you come to sell your business that there's more to its value than simply its assets. There are many different ways of valuing assets, and we don't need to go into them in detail here. However, they are the going concern value, which is that the way a business valuer or asset valuer will value assets in situ, located in the business right there. Their state of repair, their condition, what it might cost to go out and both buy them and put them in place as they are now. Secondly, the net realisable value, or what they can immediately recover once sold, less expenses, say auctioneer or intermediary expenses. And thirdly, the depreciated value, what you'll find in a depreciation schedule. That is the amount that the government has allowed you to reduce their value to for tax purposes. The next method is the discounted cash flow method. This is a more complex profit method whereby you forecast income and expenses a number of years out, generally 5 years. But then a discount rate is applied, much like a multiplier in the earlier method that we looked at. We don't need to spend too much time on it here, but we can acknowledge that it is a legitimate method of business valuation, and it is also good to note that it values the business on its future cash flows. You'll see accountants applying this method with larger businesses. It's more scientific, it's more detailed, forces you to look at income and expenditure into the future in more detail. Some people steer clear of this method because of its reliance on projections. So if the projections are wrong, one is scared of liability that might arise as a result of that. It's obvious to say that an accountant will apply this method when acting for a buyer, but will be a little less interested in applying it for a seller because of that risk. Market value. The market value of something, as we discussed before, can be obtained by looking at transactions that have occurred in the marketplace for similar items. For the market value method to have validity in business sales, there needs to be a sufficient number of transactions, and the item in question must be quite similar to the items involved in the other transactions. Hence, evidence of other transactions in relation to similar businesses is very useful to support a business valuation, but will very rarely be the only method used. Let's look at the Wikipedia definition of market value, which is applied very simply in the business sale world. Have you heard someone say when talking about business value, it's worth what someone is prepared to pay? Well, that's market value. Now, we may value a business by reference to one or more of the above methodologies. A good valuer, having arrived at the theoretical value using a profit method or the discounted cash flow method, will, as a last activity, call a business broker or another valuer to find out what other transactions have occurred in the marketplace. In summary, the important thing to know is that while you are building sales, you should also be building your business in a way that increases the profit multiplier when it comes to business valuation and pricing. As you go through this program, you will understand whether each dollar of sales that you added to your business is also going to increase business value, and by how much that dollar of sales will build business value. Our ideal outcome is to see you get to a situation where every extra dollar of profit adds between $2 and $4 to business value.